Atsi Seth. She's Vice President with Moody's. She joins us from New York now. Atsi, good morning. Thank you for joining us. What would you attribute Friday's price action to? Benchmark indices took a hit of 4% plus, rupee cracked and it plunged below 61.
I think if you're referring to the equity market performance, that probably has two sources. One was global. If you look at the performance, for instance, in U.S. equities during the week, that too was on the negative side. And I think that definitely global markets seem to be connected more and more these days. So that partly influenced, I think, equity performance in India. But then there were, of course, domestic sources as well. A clear one is the growth outlook for India, which remains, and new data over the last couple of weeks has confirmed that the growth outlook remains subdued, and that, of course, affects corporate profitability and equity market performance. And then secondly, the measures that have been taken by the Reserve Bank and by authorities to stem the decline in the rupee might have been interpreted by some as renewed capital controls. And insofar as capital controls are a negative flag for foreign portfolio investors, that probably contributed to it as well.
Atsi, hi, morning. Do you believe stakeholders have misinterpreted these measures as capital control? Because it has been clarified several times over, only tweaking an automatic route for ODI limits.
You know, one thing to make very clear is that India has had a certain amount of capital controls before and will likely continue to have capital controls into the future. Indian authorities have been very clear that capital account liberalization is something they will sort of address with caution. So in our view, India has always had capital controls. The measures that we saw announced recently were indeed adjustments in the amount of controls. So depending on what your own view is, you can interpret it as new capital controls or an adjustment of capital controls. But the fact is that there were capital controls before, there will be capital controls now, and the amount of control is what is being adjusted now.
Atsi, but these measures by the government have hugely dented investor sentiment, but they also have impacted the underlying attractiveness of India as an investment destination.
In general, I think what's affecting the attractiveness of the country as an investment destination is two factors. One is the growth outlook itself. That look, the data that we've seen coming in supports the idea that over the next couple of quarters at least, you're not going to see an acceleration in growth. So that is definitely one factor playing on investors' minds. The second is the policy environment. We saw over the last year that there has been a flurry of announcements starting last autumn, that's the autumn of 2012, which have been sort of, seen positively by some because they opened the doors to investment in certain sectors, they liberalized regulation in certain other sectors. But the net result of all those announcements has still not a year later been reflected in growth. And there is still uncertainty as to what next will come from the government or the authorities that will really propel an improvement in the investment outlook. And I think until there is some clarity that the government is going to take measures that will actually lead to private investors making direct investments, the attractiveness of India as an investment destination, I think, will remain subdued.
I'd say India recently unveiled a roadmap to tackle the current account deficit as well. It plans to contain the current account deficit at about 3.7% of the GDP and also fully finance it. Do you believe it is doable, or does it seem like a Herculean task?
India's current account deficit itself owes to several different factors. One is the global economy itself, which in the past 1 year, export growth in general, the world over, has been largely subdued, and that has affected India as well. So in that sense, the roadmap from India won't affect it to a great extent, but what will affect the current account deficit is if global growth picks up, and we're seeing some signs of that. So if that comes to play, then indeed I think the export outlook might improve to some extent, and that will help the current account deficit. The measures that the government has announced, I think, are quite limited in scope. They are, import controls to some extent on gold and oil, and that might have a marginal impact. The other measures in terms of inviting investment, I think until the investment climate itself looks up, those measures are likely to be less effective.
Actually, the fall in rupee also has been relentless. Do you think the government has got the strategy wrong, or perhaps it has not fully utilized all its options to curb forex volatility?
Purely from a macroeconomic perspective, if you look at currency movements, that when you're in market-based economy and a fairly open economy, as India has become over the last 10 years, your currency will adjust to what is going on both inside the country and the outside of the country. So while the view is that this rupee depreciation is somehow a very negative development, I think it is not a very unpredictable or surprising development given what's going on inside the country and outside the country. When growth declined in India, you knew that portfolio flows, probably capital flows in general, would slow down. That affects the rupee. When the global growth environment slowed down, you knew that affects Indian exports, and that would affect the rupee. So I wouldn't say the rupee's decline is such a surprising development. It's certainly been very steep, and it's been very sudden, but I think the rupee is merely adjusting to what is already evident both inside the country and outside the country.
Actually, the government expects the rupee to find its own level. Do you think 61, 62 to the dollar is the new normal that we have to make peace with?
I think the current level of the rupee, the 62 or whatever level it finally reaches, is a reflection of the domestic structure of the economy right now. And it's a reflection of the domestic sort of economic circumstances. So if growth remains at current levels, if the fiscal deficit remains at current levels, and if the current account deficit remains at current or anticipated levels, then clearly there is no argument for the rupee appreciating sharply. However, if you're looking ahead to the next year or two and growth accelerates from current levels, the fiscal deficit narrows, and the current account deficit narrows, then there can be a macroeconomic case made for the rupee adjusting upwards. I think, and of course the reverse can be said too, that if growth decelerates and all the rest follow, then further depreciation of the rupee could be something that you could visualize. But at this point, I think what the rupee is reflecting is the three factors: a still wide fiscal deficit, a very wide current account deficit, and a poor growth outlook.
So how worse can the Indian macros get from here? And could India be staring at a sovereign downgrade?
India's Baa3 rating, as I've mentioned in the past, is actually the lowest of, say, the BRIC countries, and it's not a very high rating. One of the reasons it's not higher than Baa3 is because we believe that wide fiscal deficits, the exposure to global trends, constrains that rating. So that rating, all of what you've described right now, is already incorporated into the Baa3 rating and the stable outlook that we have on the rating.
It's good chatting with you. Appreciate you taking the time out and speaking with us today.